concepts and determination. Most of the firms carry on their business basically with two kinds of assets: fixed assets and current assets. The management of current assets is widely understood as working capital management. Ipso facto, it also implies the discussion on current liabilities. The management of working capital, which constitutes a major area of decision making for financial manager, is a continuous function which involves the control of every ebb and flow of financial resources circulating in the enterprise in one form or another. It also refers to the management of current assets and current liabilities. Efficient management of working capital is an essential prerequisite for the successful operation of a business enterprise and improving its rate of return on the capital invested in short-term assets. As a matter of fact, the operational efficiency of a business unit is solely dependent on the prudent management of working capital. Working capital may be defined in two ways: either as the total of current assets or as the difference between the total of current assets and total of current liabilities. The first one, total of current assets, is known as gross concept of working capital, and the second one, difference between the total of current assets and total of current liabilities, is known as net concept of working capital. Gross concept. According to this concept, working capital is nothing but the total of current assets for the following reasons. Profits are earned with the help of the assets, which are partly fixed and partly current. Logic then demands that current assets should be taken to mean the working capital of the corporation. With every increase in funds, the gross working capital will increase, while according to the net concept of working capital, there will be no change in the funds available for the operating manager. The management is more concerned with the total current assets as they constitute the total funds available for operating purposes than with the sources from which the funds came. Net concept. Contrary to the aforesaid points of view, as per net concept, working capital is the mere difference between current assets and current liabilities. The net concept is advocated for the following reasons. In the long run, where what matters is the surplus of current assets over current liabilities. In this concept, which helps creditors and investors to judge the financial soundness of the enterprise, what can always be relied upon to meet the contingencies is the excess of current assets over current liabilities, since it is not to be returned. And this definition helps to find out the correct financial position of companies having the same amount of current assets. For example, if a company has 10 crore as current assets and B company also has the same amount rupees 10 crore as current assets, but current liabilities in case of A company is rupees 2 crore, while in B company it is rupees 4 crore. Then in A company, the working capital will be rupees 10 crore minus rupees 2 crore, that is rupees 8 crore, while in B company it will be rupees 10 crore minus rupees 4 crore, that is rupees 6 crore. Means it is actually giving the correct financial position of companies. In general, the gross concept is referred to as the economic concept, since assets are implied to derive a rate of return. On the contrary, the net concept is said to be the point of view of an accountant. In this sense, working capital is viewed as a liquidation concept. Constituents of working capital: inventories, which include raw materials and packing materials; work in progress, finished and traded goods, stores, spares, and fuel. Second is sundry debtors, debts outstanding for a period exceeding 6 months, other debts. Three is cash and bank balance, with scheduled banks, in current accounts, in deposit accounts, with others in current accounts. Loans and advances, secured advances, unsecured but considered good. Advances recoverable in cash or kind for value to be received. Deposits balanced with customs and excise authorities. And current liabilities includes sundry creditors, unclaimed dividend warrants, unclaimed debenture interest warrant. Short-term credit is also part of current liability, and short-term credit includes short-term loans, cash credit from banks, other short-term payables. Current liabilities also include provisions for taxation, proposed dividend on preference shares, on equity shares. Besides items like prepaid expenses, certain advance payments are also included in the list of current assets. Similarly, bills payable, income received in advance for the services to be rendered, are treated as current liabilities. Nevertheless, there is difference of opinion as to what is current. In the strict sense of term, it is related to the operating cycle of the firm, and current assets are treated as those that can be converted into cash within the operating cycle. The period of the operating cycle may be more or less compared to the accounting period of the firm. Or, in practical sense, you may say current assets are those assets which are recoverable in the period of 12 months, and current liabilities are those liabilities which are payable in the period of 12 months. Because 12 months is normally the accounting period or operating cycle of the firm. Types of working capital. Sometimes working capital is divided into two varieties as permanent working capital, variable working capital. Permanent working capital. Though working capital has a limited life, usually not exceeding a year, In actual practice, some part of the investment in that is always permanent. The minimum level of investment in current assets that is required to continue the business without interruption is referred to as permanent working capital. For example, cash. Some cash is must. You can't say that the end of the year the cash will be zero because the cash will be required even on the next working day of the next accounting period. In the same way, debtors. Normally, there is a practice that debtors make last payment and at the same time they get goods purchased for the next period. Means some amount will always remain invested in the debtors. Variable working capital. This is also known as the circulating or transitory working capital. This is the amount of investment required to take care of the fluctuations in the business activity. While investment in permanent portion can be predicted with some probability, investment in variable portion of working capital cannot be predicted easily as sudden changes in the business activity cause variation in this portion of working capital. Working capital behavior. These four charts, they will give you some concept regarding behavior of working capital. One of the implications of the division of working capital into two types is to understand its behavior over a period of time. Investment in working capital is related to sales value. The variation with respect to different types of firms are presumed to vary as indicated in the following figure. If the firm is non-growth, non-seasonal, non-cyclic firm, there will be only permanent working capital, or you may say there will be no change in the working capital. If the firm is growing but non-seasonal and non-cyclical, then there will be permanent working capital. There will be no variable working capital, but the permanent working capital will have a rising trend. If the firm is growing, seasonal and non-cyclical, there will be permanent working capital just like the previous one. But at the same time, there will be some variable working capital which will sometimes increase, sometimes decrease. But overall, this will go with the rising trend of permanent working capital. Then, in case of growing, seasonal, and cyclical firms, the behavior of working capital will be just like previous one, but the frequency will be faster than that. Cyclical flow and characteristics of working capital. For every business enterprise, there will be a natural cycle of activity. Due to the interaction of various forces affecting the working capital, it transforms and moves from one to other. However, The successive movements in this cycle will be different from one enterprise to another based on the nature of enterprise. First, I want to make it clear that the cyclical flow of working capital is converting cash to different other forms of working capital, and then in the last again reconverting it into the form of cash. If the enterprise is a manufacturing concern, the cycle will run something like this: cash to buying raw materials, then production, then finished goods, then sales, naturally on credit. They will convert into accounts receivable, then there will be collections, and now again it is cash. This is full working cycle or operating cycle. In the enterprise, it is if it is purely a retailing company and one which has no manufacturing problem, the cycle is sorted as cash through buying merchandise, then sales is there, it is converted, merchandise is converted into accounts receivables, then collections are there, and it is reconverted into cash. If the enterprise is purely financial enterprise, the cycle is still shorter, and it can be shown as cash, sanction of loans, they will become debtors, and collection, it will become cash. Means the cyclical flow of working capital depends on the nature of enterprise or nature of firms. One can easily identify three important characteristics of working capital. The first one, short life span. Components of working capital are short-lived. Typically, their lifespan does not exceed 1 year. In practice, however, some assets that violate this criteria are still classified as current assets. Swift transformation and interrelated assets forms. In addition to their short span of life, each component of the current assets is swiftly transferred into the other assets. As we have seen in the last diagram, that cash is converted into receivables, and then receivables are converted into cash. Sometimes cash is converted into production, merchandise, then it is converted into receivables, then in the last it is again converted into cash. And this is swift transformation going on continuously on the daily basis, even on the hourly basis as well. Assets, forms, and synchronization of activity level. A third characteristic of working capital components is that their lifespan depends upon the extent to which the basic activities like production, distribution, and collection are non-instantaneous and unsynchronized. If these three activities are only instantaneous and synchronized, the management of working capital would obviously be a trivial problem. Planning for working capital. Planning provides a logical starting point for many of the decisions. It is very much true for working capital decision also. While working capital planning is a part of financial planning, the responsibility permeates among different managers within the organization responsible for managing different components of working capital. Now, tools for planning for working capital. It should be interesting to know how to identify the relevant tools for completing the planning exercise. Treating the planning for working capital as part of financial planning, we can note down the following tools of analysis with respect to time frame. Short-term planning, that includes cash budgeting. Medium-term planning, determination of appropriate levels of working capital items. Long-term planning, projected payouts and returns to shareholders in terms of CVP, cost volume profit analysis, and fund flow analysis. These cash budgeting, CVP, fund flow, determination working capital items we will discuss one by one. Short-term planning. First, cash budget. In the short term, budgeting is considered a handy device for planning working capital. Cash budget is prepared by the organization by borrowing figures from various other budgets, such as the following. Production budget means input will be from the production department. Sales budget, here the input for cash budget will be received from the sales department. Cost of production estimates with its necessary subdivisions, for example, material purchase estimates from the purchase department, labor and personnel estimates from the personnel department, plant maintenance estimates from the maintenance department. Manpower budget. Here the input will be received from the HR department. Township and welfare estimates. Profit and loss estimates. And capital expenditure budget. Means for preparing a cash budget, the input will be received from the various departments of the firm. Almost all the departments are involved in the preparing of the cash budget. Medium-term planning. In the medium term, determining appropriate level of working capital is considered a focal point. The three approaches to determine optimum investment in working capital are industry norm approach, economic modeling approach, and strategic choice approach. All these three approaches we will discuss sometime after. Long-term planning, cost volume profit analysis. As a measure of long-term planning, macro level techniques like CVP and funds flow are considered helpful in making an effective plan. Funds flow is yet another tool used in the long run to analyze the financial position of a company. Though the term funds can be understood to include all financial resources, but preparation of fund flow statements on working capital basis are more common in finance. Working capital and inflation. Inflation, which is commonly indicated by the rise in prices of goods and services, is so rampant in the world that no economy is far from its deleterious effects. The impact of working capital could be understood in the following manner. Size of working capital. Inflation causes a spurt in the prices of input factors like raw materials. Raw material cost is increasing day by day. If you have seen, for a factory which is producing tomato puree, the cost of tomato has increased so rapidly in the last few days. At the same time, all other factors there is spurt in the prices. They are labor, fuel and power. Even though there is no increase in the quantum of such input factors used, means the quantum may remain same, but the total expenditure will increase. Secondly, inflationary conditions by providing motivation for higher profits. When there is price rise in the market, the owner of the enterprise also wants more profits because the cash is losing its value. And then this price rise induced the manufacturers to increase their volume of operation. Thirdly, companies also tend to accumulate inventories during inflation to reap the speculative profits. Speculative profits means, suppose a component of raw material is available at cheap prices in the market, the enterprise wants to purchase it in large quantity, and that requires certain investment in the working capital. This kind of blocking up of funds in turn necessitates enterprise to maintain larger working capital funds. Availability of working capital. Besides the problem of increased demand for funds, there would be a reduction in the availability of such funds associated with higher costs during inflation. Components of working capital. It may be interesting to consider the impact of inflation on the components of working capital, namely inventory, receivables, and cash. Inventory. Inflation affects the decision in respect of inventory in many ways. It leads to overinvestment in inventory. We have just discussed speculative motive. It results in shortages of inventory, sometimes shortages of cash also to invest in inventory. It affects valuation of inventories. It renders the traditional inventory control technique ineffective. During the periods of inflation, when the prices rise rapidly, companies will have an incentive to invest more heavily in inventory. Another difficulty that the company is required to face is the material shortage in the periods of inflation. For example, again the same example, in the market, the prices of tomato is going higher and higher, and at the same time, tomato is not available in the market. Not only inflation affects inventory, but inflation itself is also increased due to inefficient management of inventory. Now, the second concept, receivables. The effect of inflation on the receivables is felt through the size of investment in receivables. When the prices have increased, if we sell the same amount of goods, the value of that goods has increased, and therefore the amount of receivables have increased. The amount of investment in receivables varies depending upon the credit and collection policies of the organization. If we give credit for 10 days, and another example, if we give credit for 20 days, in case of 20 days, the investment in the receivables will be more. Collection policies will also affect the size of receivables. If there are strict collection policies, the receivables will be collected speedily, but at the same time, we will also lose some customers. Evidently, during the periods of inflation, the higher the amount involved in receivables, the greater would be the loss to the company, since the debtors would be paying cheaper rupees. When the sale was made, the value of rupees was higher. When the amount is collected, the value has become less on account of inflation. You know that 1 rupee last year has not got the same value that of 1 rupee this year. In 1 rupee last year, the goods and services which you can purchase last year, you can't get in 1 rupee this year. Cash, the last item of current assets. Management of cash takes on an added importance during the period of inflation. With money losing value in real terms almost daily, idle cash depreciate rapidly. Thus, we have just discussed it. Means if you keep the same amount of cash, the value will depreciate after some time. During inflationary periods, it is important that cash is treated as an asset required to earn a reasonable return. Means the cash should also, the cash which is kept for emergency period should also be invested in quick assets. The loss on the excess cash may be offset or partly mitigated if it is invested to produce an income in the form of interest earned. Operating environment of working capital. The term environment is meant to a large extent to signify the surroundings of factors that are external to the firm, affecting the ability of the firm in achieving its desired objective. The nature of environment is such that the firm will have no control on the elements constituting the environment. As applied to working capital decisions, the following elements of environment are considered relevant. Changes in the monetary and credit policies. Changes in inflation and changes in financial markets. We will discuss them one by one. Monetary and credit policies. In the conduct of monetary policy, the following aspects become pertinent. Money supply, bank rate, CRR and SLR means cash reserve ratio and statutory liquidity ratio, interest rates, selective credit controls, and flow of credit. Money supply. As a part of the policy exercise, monetary growth is targeted every year. Policy measures are pronounced so as to take care of this targeting exercise. This is expected to maintain real growth and contain inflation. In this context, the central bank specifies the order of expansion in broad money. Broad money, popularly known as M3, and this comprises of currency with the public, actually the notes actually in circulation, demand and time deposits with commercial banks, which are for the short term, and other deposits with RBI. This broad money or M3 would be used as an intermediate target to realize the ultimate objective of the policy. In case of India, both output expansion and price stability are important objectives. Naturally, a developing economy wants that there should be output expansion. But see, if we take general public's interest in mind, the price stability is a must. Therefore, in case of these developing countries like India, both output expansion and price stability both are important objectives. But depending on the specific circumstances of the year, emphasis is placed on either of the two. Means if the time demands that price control is necessary, then the emphasis will be on the price stability. Otherwise, emphasis will be on the output expansion. Now the bank rate. The bank rate has been defined in Section 49 of the Reserve Bank of India Act 1934 as the standard rate at which the bank is prepared to buy or rediscount bills of exchange or other commercial papers eligible for purchase under the Act. You may say bank in simple words, you may say that the bank rate is the rate on which Reserve Bank or the central bank of the country gives loan to the commercial banks. The significance of bank rate is that it indicates the rate at which the public should be able to obtain accommodation on the specified type of paper from the commercial banks as well as the central bank. In practical life, public goes to the central bank but only through the commercial banks. Means commercial banks go to the central bank. This is expected to curb the tendency towards relatively high interest rate and ensure satisfactory banking services and reasonable rates to the people. Secondly, bank rate represents the basis of the rates at which people can obtain credit. Thirdly, bank rate also has an important psychological value as an instrument of credit control. In effect, a change in the bank rate is to make the cost of securing funds from the central bank cheaper or more expensive. If bank rate is increased, it will become expensive. If the bank rate is reduced, then the securing funds will be cheaper. Bring about changes in the structure of market interest rates and serve as a signal to the money market, business community, and the public of the relaxation or restraining credit policy. CRR and SLR, cash reserve ratio and statutory liquidity ratio. Variations in the reserve requirements is yet another credit control technique used by central bank. The central bank by this technique can change the amount of cash reserve of banks and affect their credit creating capacity. The two instruments under this category are cash reserve ratio and statutory liquidity ratio. Under Section 42(1) of the RBI Act, scheduled commercial banks are required to maintain with the RBI at the close of business on any day a minimum cash balance or cash reserve on the demand and type liabilities. Similarly, banks required under Section 24(2)(a) to maintain a minimum amount of liquid assets equal to but not less than certain percentage of demand and time liability. It is to be noted that in this context, the Indian economy has undergone major reforms leading to the era of liberalization, privatization, and globalization. In short, we may say LPG. This LPG is not for the cooking gas that we use in our homes. This LPG is liberalization, privatization, and globalization. Keeping these changes in view, economy has been thrown open to private initiative, and the government is seeking to withdraw its presence in business and industry. Making available credit to the maximum extent is the motto of government. Therefore, policy measures are also kept in tune with this trend and philosophy, and these ratio CRR and SLR they changes rapidly according to the need of the market. Interest rate. Realizing the fact that bank rate is not functioning as an effective tool of credit control, RBI started influencing the cost of credit through the changes in interest rates. RBI derived the authority to regulate the interest rates of bank under section 21 and 35A of the Banking Regulation Act 1949. This power covers both the advances and deposit rates. The rates on loans and advances are controlled mainly in order to influence the demand for credit and to introduce an element of discipline in the use of credit. Recent policy changes in this regard include interest rate on domestic term deposits with maturity of 30 days to 1 year was linked to the bank rate, bringing under the same ceiling the non-resident external NRE account rupee term deposits with that of domestic term deposits. Allowing banks to announce a separate prime term lending rate PTLR for term loans of 3 years and above. This is separate to the bank rate and which is announced by every individual bank, making the banks to announce the maximum spread over the PLR for all advances other than consumer credit. Sometimes more than 2% or 1% above the PLR, permitting banks to prescribe separate prime lending rates for loans and cash credit components and also separate spreads for both the companies. Means there will be a separate rate for loans and another rate for cash credit, permitting banks to provide foreign currency denominated loans to their customer for meeting either their foreign currency or rupee requirements. freedom for banks to decide the rate of interest on post shipment export credit on medium and long term basis. In recent years, there has been a persistent downward trend in the interest rate structure, reflecting moderation of inflationary expectation and comfortable liquidity situation. As a matter of fact, there had been a dramatic shift in the interest rate regime in India. Surprisingly, a high interest driven economy turned into a low interest rate economy and tried to compete with the advanced countries in keeping interest rates low. If you see in the modern world, in case of advanced countries like USA, UK, France, Germany, etc., the interest rates there are very low, sometimes 1% or 2%, while in India it is high. But India is also on that path where the interest rates are becoming low. Selective credit controls. Central banks generally have a policy to use qualitative techniques in addition to the quantitative techniques of credit control. Quantitative techniques which control the quantity of the credit. Qualitative technique which is related to the quality of the credit. The most widely used of the qualitative technique are selective credit control and moral suasion. However, the situation has changed recently after the implementation of new economic policy in 1991, or you may say after the LPG liberalization, etc. There has been a phasing out of the selective credit control. By the end of 1996, almost all the controls were virtually eliminated. RBI now only gives directions, and it is banks that are required to follow. And mostly these directions are advisory in nature. Now the financial market. The role of financial market is paramount in the mobilization and allocation of savings in the economy. They are the agencies that provide necessary funds for all productive purposes. The main organized financial market in India are the credit market, which is dominated by commercial banks, where loans and cash credit are given to the customers. Second one, the money market, with call money segment forming a sizable proportion, where the money is advanced for a very brief period. Third one, equity and term lending market, consisting of primary, secondary, and term lending segment. Primary means issue by the companies, secondary, stock exchanges, and then term lending segments. Fourth is corporate debt market, comprising PSU bond, public sector units, and corporate debentures. Fifth, gilt as market for government securities, which is considered to be the most secured advances or most secured investment in the country. Then housing finance market, where finance is provided to the customers for purchasing or constructing the house. Hire purchase and leasing finance market, where assets are sold on hire purchase or they are leased to the customer. And here the non-bank financial companies, NBFC, predominate. Next one is insurance market, which includes insurance companies, LIC, etc., and private companies also. And foreign exchange market, where foreign exchange are dealt with. Apart from these 9 financial segments of financial market, there is an unorganized and informal finance market comprising of money lenders in villages and indigenous bankers in towns and cities. All the agencies, means all these total agencies constitute the financial sector of India. The significant steps that were taken to promote efficiency are a strict criteria was involved for companies that access securities market. Means where action is also taken for the lapses. The Securities and Exchange Board of India, popularly known as SEBI, took several steps for widening and deepening different segments of the market for promoting investor protection and market development. The safety and integrity of the securities market were strengthened through the institution of risk management measures. Reforms in the secondary market focused on improving market transparency, integrity, and infrastructure. FIIs were permitted to invest up to a fixed percent in equity of any company. And lately, this percentage has reached up to even 100%. Take the example of government has also initiated measures to deepen and broaden the government securities market and increase its liquidity. The earlier restrictions that debt instruments of a corporate could be listed only after its equity had been listed on any exchange was removed. Investment guidelines regarding the utilization of funds of LIC were revised. And the last one, the mutual fund regulations issued by SEBI in 1993 were further revised in 1996 and are being amended from time to time, and the latest amendment taking place on January 25, 2022. That's all. Thank you.